Good afternoon and welcome to the Inspired PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Mark Dickinson, CEO. Good afternoon to you, sir.
Good afternoon, everybody, and welcome to our final results presentation for 2021. Your presentation team today is myself, Chief Exec, Paul Connor, CFO, and a new face to the executive team, David Cockshott, who's joined the executive board as Chief Commercial Officer. David, would you like to say a few words to introduce yourself?
Yeah, thanks, Mark. Dave Cockshott, I've been with Inspired almost 2 years now, so time flies. But actually, I've been in the energy industry for over 30 years, mainly on the supply side, but I have done 2 stints with consultancies as well. So looking forward to bringing some of my sector expertise towards Inspired and enjoying the role so far.
Perfect. Thanks, David. Welcome aboard. So, guys, I guess one of the first things to do is to make sure we remind everyone of the purpose of Inspired PLC. We evolved into Inspired PLC during 2021, and our purpose is to help corporate businesses deliver net zero and respond to climate change whilst controlling their costs. And the controlling their cost part is really important because there's lots of ideology and intellectualization in this area. And ultimately, our solutions are designed to be pragmatic, practical, and cost effective. The evolution to Inspired PLC has allowed us to split into 3 divisions. The energy division that everyone's known for many years, the ESG division, which represents the part of the business where we make disclosures for clients and is a new organic entry, and the software division, which is where we hold our proprietary software that underpins our technology-enabled service and that we also make available to third parties. This is the first year, I'm pleased to say, we've been able to provide full segmental reporting, and Paul Connor will take us through that as he works through the financials. In terms of operational highlights, I guess we delivered significant progress throughout 2021. The first half of the year was dominated by the kind of residual challenge from COVID, reduced consumption, and a difficulty in accessing client sites in relation to providing optimization services. We managed ourselves through that process pragmatically and diligently to leave ourselves in a position where, as COVID did unwind, we were able to rebound strongly in H2, in particular via the Energy Optimization Service division, which achieved record revenues. We broadened our customer base from 3,400 to 3,500 in the UK and successfully delivered 1 million of revenue from our ESG Services division in its first full year of operations, pioneering a pragmatic and practical data-driven service to ESG disclosures. We've continued to develop our software capability and expand the platform, and are really pleased to say that the number of third parties using the software increased by 20% during 2021. It's important in this new world, as well as making effective financial disclosures and financial updates, that companies also make effective ESG disclosures. We did that during 2021 with the voluntary public-owned TCFD, Task Force on Climate-Related Financial Disclosures report, and also our first full ESG report. The group also was delighted to retain its Green Economy Mark status during 2021. Of course, as we get to the second half of 2021, the energy crisis that everyone's well aware started to grip the country and has been exacerbated by the situation in Ukraine and the abhorrent actions of the Russian regime. That kind of has created a number of if you like, operational challenges, which the organisation is working hard to support customers with and to make sure that they are well placed to manage themselves through that crisis. In terms of acquisitions, we completed the acquisitions of BusinessWise and General Energy Management in 2021, deploying the remainder of the 31.3 million capital we raised in 2020. I'm pleased to say that both businesses are integrating well and performing in line with expectations. Post-period, we completed the acquisition of Digital Energy. This is a small software business which will bolt into our software solutions division. Whilst only small in terms of EBITDA contribution, it does bring us an extra 30,000 meter points into the Inspired portfolio. Really pleased to see the strengthening of our board during 2021. Richard Logan being appointed as non-executive chair, Sangeeta Shah and Dan Walker joining the board as independent non-executives, and of course Dave joining as we've met today will really start to increase our bandwidth in terms of being able to effectively execute and deliver our growth strategy. So I'm going to hand over to Paul to take us through the financial performance of the group during FY21.
So in terms of financial highlights, so this was a milestone period in terms of financial reporting for the group, in that it's the first full year we've reported under the new segmental reporting structure. So 3 operating divisions: Energy Solutions, ESG and Software Solutions, which breaks down into 4 reporting segments, with Energy Solutions breaking out into Assurance Services and Optimization Services. What that allows us to do is give investors, stakeholders, readers of our account a greater understanding of the differing revenue models of each segment, the different margin levels, the different cash conversion metrics, and also the different growth expectations moving forward. Before we go into the segmentals, in terms of group highlights, so we saw a period of recovery, rebound and acceleration throughout the year. So 47% increase in revenue, 37% of which was organic, with the remainder being contributed by the acquired businesses. So business-wise, GEM that we acquired in March this year, and a full year contribution from LSI, which we acquired in August 2020. That flowed through in terms of EBITDA growth, PBT growth, again flowing through into EPS growth. From a balance sheet and cash flow perspective, the group finished the year with net debt of 32.9 million, having started the year with 18.8 million. But the key point there is that the net debt at the half year was 30.2 million, subsequent to the deployment of capital into the business-wise and GEM transactions in March 2021. Underlying cash generated from operations, 10.2 million, down from 11.6 in 2020. So that increasing in revenue, in profits, should I say, not necessarily flowing directly through into cash. And that's driven wholly by an abnormal working capital period for the optimization business. So the optimization business, having been largely in standstill, underutilized at the back end of 2020 and Q1 of 21, because, as Mark says, the inability to access client premises, and then the lifting of restrictions in Q2 2021, and favourable market conditions in the second half of the year in terms of energy prices, reducing payback periods for customers, resulting in an acceleration within that division throughout the abbreviated 9-month period, and particularly into the year end, which drove a 9.8 million increase in trade receivables. In terms of how that's unwound since the year end, as of now, we've collected in excess of 80% of that balance, and we expect the remainder to be collected in Q2. The cash performance, an expected cash performance in 22, gives us the confidence to continue to tick up the dividend, but remaining within the dividend policy, having reinstated the dividend post-COVID, of dividend cover at least 3 times. So the segmental reporting. So you've got the Energy Solutions, which contributed 95% of revenue, 52% from the Energy Assurance division, and 43% from the Energy Optimization division. So Energy Assurance, 48% strong EBITDA margin in the period, 20% revenue growth, 5% organic. So the acquisitions that I referred to previously in business-wise, GEM and LSI, were wholly focused on the assurance part of the business. High cash generations, 80% of adjusted EBITDA turned into cash generated from operations. And that was subsequent to a couple of exceptionals, including the payment of the Q2 2020 VAT, which was deferred across the board in the depths of COVID. Energy Optimization Services. So period, as I say, of rebound, recovery, and acceleration, driving that 100% increase in revenue in the period, all of which was organic, and going from a period of a 0.5 loss at the EBITDA level through to a material contribution to group EBITDA of £5 million, but not necessarily flowing through into cash generated from operations because of that receivables increase into the period end. Software solutions, 13% growth organically, which we expect to continue into the next couple of years. High EBITDA margin, tick up in margin because of us generating that operational leverage within a software business. High operating cash conversion, again, as you didn't expect within that business model. ESG solutions. So from a standing start in 2020, we doubled the revenue to £1 million in the period, yet to contribute to materially to EBITDA of the group as we continue to invest into that space. And in terms of a look forward, we guided the market yesterday. We expect to put in a further £1.5 million into the ESG Solutions division in 2022 to stimulate and facilitate an acceleration of the growth in that area. So that's the key financials.
Thanks, Paul. So in addition to giving financial disclosures and financial updates, it's increasingly important that businesses give ESG updates in relation to investors. And Inspired provides these services to a number of organisations to help them make effective disclosures. So it's right and proper that we also make those ourselves. In terms of making disclosures, you get a number of people who are maybe fixated on the idea of this is difficult, it's cost effective, you can't do it in a way that's useful. Actually, we would take issue with all that. The key to it for us on the environmental side is that every organisation should be creating a carbon balance sheet. That carbon balance sheet is going to produce the greenhouse gas inventory for the organisation, which is a set of rules and framework which is kind of undisputable. There's just a methodology, and there's no reason why every organisation can't produce this. We then move to kind of actually add to that an operational analysis so that every organisation can work out its carbon cost of operations. We've done this from Inspired, both in 2020 and in 2021. And what's important about your carbon cost of operations is that this is the bit where if you want to make yourself carbon neutral by using offsets, then you can ultimately do that. And when you're then, as like an organisation like ourselves, who's working with a number of big clients, we can provide those clients with a certificate to say when they're calculating their own greenhouse gas inventory, they can put a 0 in their scope 3 emissions for the services they receive from us because we've already got it covered. It's a great differentiator, and by doing the analysis, organisations can really start to make that difference in the way they serve their customers. The final part of the carbon balance sheet is really looking at where the things our business does also has a carbon benefit further in the chain. So what you can see there is that we've invested 540 tonnes of carbon in our carbon balance sheet and made 10,000 tonnes of difference to our customers. It's where we put those energy saving solutions into our customers. So I'm not going to dwell on the results in this presentation, both in terms of the sustainability side and the social value side. Safe to say that all of our full disclosures are available on our website. We'd encourage people to look at them and also look at how they're changing, not just for our organisation, but for every organisation. So you can start to take a view on the ESG impact we're all making. Our social value being a case in point. Please have a look at the disclosures on the website. What we're going to do now is, having looked at the financials, having looked at the actual overall ESG disclosures, I'm going to ask Dave now to take us through actually how our business works, how the value proposition hangs together, and bring it to life with some real examples.
Great, thanks, Mark. So first thing, how do we view our organisation? Well, the first thing, the differentiator, is that technology enabled piece. So everything we're doing is backed by the sure and safe way of recording and collating customers' data. We look after around 3,500 UK corporate businesses. That puts us, if we were an energy supplier, we're not, but if we were, the equivalent of 6.7% of the UK energy market, which would put us as one of the larger suppliers. Cornwall Insight, the independent organisation, puts us in a tier on our own in terms of our scale and the size of our business, given the fact that we are more than twice the size of our nearest competitor. So scope and scale is clearly one of our differentiating points. If we then work out what our market is, where it sits, the bottom of the pyramid, the non-discretionary act. Every business, whether you're large or small, you require electricity, you need a contract. There's no choice. How long you contract for and the style of the contract are all choices, but having a contract is not a choice. That's how you have to procure your energy, and that's just the way it is. So everybody, therefore, becomes an opportunity for Inspired. Certain customers then go on and have to do regulatory disclosures. Depending on the size of their business, things like SECR, the Streamlined Energy Carbon Reporting, and ESOS, customers have no choice. They have to report these regulatory disclosures. Because we've built up that picture of the organisation based on the non-discretionary act of the procurement side, and we've then validated those invoices that come through on the procurement side, that gives us the prime starting point for being able to help them with those regulatory disclosures. Once we've done that, the next question that's often asked is, so how can we reduce the cost? That leads us on to our energy reduction services, carbon action programs, energy management as a service. There are not many organisations that can justify having full-time energy experts. Hence, that can be outsourced to Inspired in such a way that we can provide that advice and those services of energy reduction advice to them as a service. And as I say, all of that has to be underpinned by sure technology. That technology that we've invested in for our own purposes allows us then to use that software as a service, as a solution for third parties as well. So you add all of those components together, we get to a market size of around 2.5 billion as the opportunity for Inspired. So how do we talk to our clients? Well, it depends which language they speak. The CFO speaks to cost. The energy managers or facility managers will always talk to consumption, kilowatt hours. If you're a CEO, you may be concerned about the compliance, or the risk manager is concerned about the compliance. And everybody is now talking about carbon as being one of those main drivers and topics for businesses. So how does that map out into Inspired? Well, those four cornerstones of our business, we can map all of our products across those four cornerstones, each product addressing one or more of those areas, depending where it sits in that matrix. So all of these products are available to all of our customers. Now, not all will be applicable to all, but there will be something on that range that will appeal to all potential customers for Inspired. So what does all of that mean? Let's just bring that to life, hopefully for you. So this is a real customer and is a real example of that land and expand kind of concept. We've been long talking about this, but this is the real evident demonstration of it in work. So it's a listed retailer. They have around 650 sites in the UK, and they spend around £35 million per year on their utilities. We started working with them back in January 17, and we started with that assurance service, the procurement, and then the energy accounting process. So bear in mind, there are statistics that give a 6% error rate on energy bills. Now, of course, the vast majority of bills are correct, leaving that small percentage with a potential for a very large error on them. So by validating those invoices that come through in real time as they come through, we've been able to deliver value to the client of 10.5 million. that combined with our procurement strategies. So the value's clear there to the client. We then added in water procurement, another 1.8 million of value to the client, and our fees are starting to increase. We then moved on to the regulatory disclosures that we talked about, the ESOS and the SECA compliance, further increasing our fees. Then the challenge of how do we reduce consumption. So we've deployed 6 million of capital on their behalf, with a further 8 million in the pipeline. And for that, we've actually returned them 30% energy savings, and a save of around 9,000 tonnes of carbon. Now we're in a trusted position. We are their trusted advisor for all matters relating to energy. So then we get the mandate to start looking towards their TCFD disclosures and onto a full ESG reporting service according to GRI standards. Again, as we're going through, increasing our fees. So what started out as a good sized client for Inspired, £160,000 worth of recurring fees per year, has morphed over those 4 years into a £320,000 per year client and £14 million worth of revenue from project spends. So a classic example of exactly our thesis in action of being able to become the trusted advisor, opening up more and more opportunities across our customer base.
Thanks, David. So guys, what I'm going to do now, you've kind of been through the financials, we've seen the ESG disclosure, we've brought to life the value proposition for customers. So effectively, what's that mean for our strategy kind of going forward? So I guess the first thing is, in terms of looking at the business, you can see the kind of growth metrics now per segment. So the segmental reporting for me really gives investors the opportunity to understand how the business is performing, but also to start to do their own projections on the future growth potential. So the core underlying assurance services division, that's going to give us 5 to 7% organic growth a year. Great stable EBITDA margin, and that organic growth engine is really the kind of underlying cash generator of the business. We've then ultimately got the ESG solutions, that organic entry into the market, where we're putting extra investment in this year. And whilst we'll walk through later the full potential of that, when it normalizes, we would expect that business to be able to generate a 40% EBITDA margin and really operate in a similar way to the assurance services business. The energy optimization business, which is 43% of revenues, that's got a 15 to 25% growth potential and an EBITDA margin of 20%, noting the more project nature of those revenues. Then finally, software solutions, which operates as a SaaS business, underpins our own technology-enabled service, looking for 10 to 20% organic growth there and an EBITDA margin of 75%. So hopefully what you can start to do is take a view and to obviously measure our performance against those stated objectives. How does our growth engine work? Well, for the first time, we've been able to really focus with investors since H2 last year on actually explaining how our flywheel works. So what you've got as a starting point is increasing our units of opportunity. How many carbon emission points do we manage? If our purpose is to be a leading provider of services to deliver net zero, then to be able to deliver net zero carbon, we need to be able to influence the way that our customers manage their points of carbon emission. So the first stage of our flywheel is to increase the number of those and just keep doing it. We do it by having a combination of field sales for both energy and ESG, which are separate teams. PCMG is a company which is a market-leading specialist on forensic audits, and they effectively go and find errors in historical invoices and charges for clients. We do that on a contingent fee basis, so it's easy to kind of get to work with clients. We deliver them value, and let's say, for example, we save them or recover £500,000. That's £500,000 they've got to start to work with us on our assurance services. Our software service brings in a whole load more meter points and carbon emission points, which we can start to influence and provide services to. acquisitions of GEM business-wise, that does the same. And then other things like our SDG Me tool and recommendation for investors all serve to give us access to corporate businesses where our focus is to be able to increase our portfolio of carbon emission points, our units of opportunity. What do we do with those units of opportunity? We provide services that solve complexity, that are technology enabled and rely on data management. We have two primary sources of those. One is the management of the energy cost equation, and one is the management of ESG disclosures. And the key thing there is you've got great drivers. There's non-discretionary calls to action that Dave was talking about, the mandatory reporting that we get from the ESG disclosures. Those are great calls to action, which give us a reason to work with the client week after week, month after month, delivering value and demonstrating our worth. As we do that, we move wider around the organization as we interact with the 4 Cs. And ultimately, that leads us to a C-suite interaction where we gain trusted advisor status. Once we've done that, we've earned the right to try and help the client with what is our purpose, which is to reduce carbon emissions from those carbon emission points. We do that by providing carbon action programs, which set out the targets and set out the pathway towards net zero. We help them with behavioural change so that everyone in the organisation is doing the right things to reduce carbon. We help them with deployment of the energy efficiency projects and the projects that are going to reduce carbon emission. And ultimately, at the end of all that, as when I mentioned on the carbon balance sheet, that carbon cost of operations, if the organisation does want to make themselves carbon neutral and they do want to be able to give that certificate to the customers, we will help them procure and organise the right offsets of the right quality to be able to achieve that carbon neutral status. And obviously, we'll also acquire in this space to increase our capabilities in relation to reducing carbon emissions at those carbon emission points. So we focused on increasing units of opportunity. We solve complexity and provide service routinely to gain trusted advisor status. We earn the right to make a difference in relation to carbon. The next step is to earn the right to make a difference with all the other ESG impacts. And that's ultimately going to be by partnering or acquiring businesses that can provide services in all the other elements of the ESG wheel. Okay, it's another great drive for growth. In order to make that service delivery effective, it has to be technology enabled. So the next part of our flywheel is to continually keep investing in making our technology cooler, solving more kind of problems for the clients, making sure it's market leading in relation to the service we're providing. As we're growing that technology, the next thing we focus on is really driving down our cost of providing services to each unit of opportunity. We do that by implementing robotic process automation and utilising our operations centre in Mumbai, which gives us a time advantage, which increases the quality of the SLAs that we can give to our customers. So we focus really on driving down that cost of operations. And guess what? As we drive down that cost of operations, it gives us more money to invest in getting more units of opportunity, increasing the surface area that we're able to cross-sell into, and so the wheel turns. So hopefully that gives a good understanding of how our organic growth engine works. And you saw on the previous slide the organic growth targets for each segment that we're looking to achieve. The next pillar of our growth thesis is acquisitive growth. We've got a great track record here. We've deployed an average 15 million of capital over the last 5 years, 18 acquisitions since float, and we can buy at attractive multiples. So there's a good multiple arbitrage opportunity in relation to the inspired thesis, building capability or increasing the units of opportunity that we manage. We're sized and scaled to do 3 to 5 acquisitions a year. You've seen the post-period bolt-on of digital energy, which is obviously a small one, but comes with a lot of units of opportunity. And ultimately, you would expect us to keep moving at that pace into the future. Just noting that with the energy crisis that's currently happening in the UK markets and the strong organic growth opportunities we've got, I would say that if we were going to be looking at executing acquisitions in this year, it'll be to the lower end and more back-end weighted in the year. But we continue to grow the pipeline and make sure that the opportunities are in front of us. I think the biggest part of our strategic announcement in relation to this year is the EBITDA investment into ESG. So for those who don't remember, the ESG Marketplace is growing in size and scale all the time because investors are coming under increasing or placing their fund managers under increasing pressure to actually make ESG disclosures. Those fund managers in turn put pressure on the companies in their portfolio. I think we've had 16 inquiries over the course of the last year, and we need to be able to make those disclosures. Also, there are mandatory disclosures for companies of certain size. So Inspired counts as a public interest company. We need to make mandatory disclosures in SEC and ESOS and TCFD from next year. But what you realize is when you make those disclosures, actually, it's not much more effort to make a full ESG disclosure, which really helps in making yourself attractive from an investment point of view to investors. The other side of this, though, is equally every ESG disclosure requires inquiry of your supply chain. So it's not just the companies who've got the mandatory obligation or the bigger companies. Actually, every company out there needs to start making some kind of ESG disclosure. If you want to win a government contract now, you have to provide your strategy towards net zero. You have to provide disclosures to what you're doing with respect to social value. And ultimately, those are the services we help organizations with. The opportunity is that 1.1 billion market that Dave told us about. And if we just looked at our clients being in the lighter blue boxes compared to the overall number of businesses in each of the segments, if we just fully penetrated our client base with services that we know we can sell. So we proved concept on this last year. So we delivered service, we create our operating model, we know what price point we can achieve on each of these segments. That if I could 100% penetrate our existing client base, that would be a £43 million increase in our revenue line. Now, in terms of the EBITDA investment we're putting in, you can see that in 2021, we made 1 million from ESG services. We had 219 clients, which were kind of the smaller ones doing SECA, but of those, 31 took the higher value services in terms of ESG and carbon balance sheets. And we did that really with a headcount of 9, which we brought in organically and paid for from our operational leverage last year, backed by some central service provision. The 1.5 million EBITDA investment is really over the next 5 years to take that to 600 clients, a future headcount of circa 100, delivering 10 to 15 million pounds of revenue, all on an organic basis. The ESG market is one of the most exciting things I've seen since I started in energy back in 2000 when I was running my first bootstrap organization. A lot of the dynamics are the same. It requires technology-enabled service provision. Inspired is really well placed to provide that. We've proved concepts, and ultimately, in terms of the opportunity, it's time banded now. To the pressure to deliver responses to climate change is there now, and ultimately for us to remain well placed and to kind of actually take our fair share of that market, we are very excited to be making this investment at this particular time. So what's the outlook? We need to manage the short-term impact of the war in Ukraine and the energy crisis, and we're helping clients navigate their way through that and make sure that they're kind of succeeding in what are very difficult times. We're focused on delivering the optimization services cross-sell with high energy prices. Paybacks on projects have halved, and ultimately organizations need to deliver those projects to manage their costs, but also to deliver net zero carbon. And we're going to continue scaling our software solutions that really underpin our technology-enabled service, mean that we get twice the bang for our buck for a capital investment we have to make anyway, and also allows us to professionalize our M&A pipeline, where when we're often by making acquisitions, we're acquiring companies that use our software, and that makes integration all the easier. We're going to continue to accelerate our ESG growth, as we've explained with the investment. And I'm pleased to be able to say that Q1 trading in the first couple of months of the year, in line with expectations and looking as good as it could in the circumstances we find ourselves in from a macroeconomic perspective. Thank you very much for listening. That's been our results. I'll now hand back to Alexandra.
Mark, Paul, David, thank you very much for your presentation. If I could just ask you to bring your cameras up for the Q&A, that'd be great. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Paul, could I ask you to read out those questions, and if the team could give their responses where it's appropriate to do so, that'd be great. And then I'll pick up from you at the end.
Yeah, absolutely. Thank you, Paul. So, question from John S. Have you now fully integrated your recent acquisitions? Were key personnel subject to lock-ins? So that's one for Mark.
Yeah, so our approach to integration is always to treat each business pragmatically and do the right things for those businesses at the right time. Typically, our structures you'll be able to see in terms of the contingent consideration. We put some long tails on those to really make sure that the vendors remain aligned with us. And so that's one of your primary reasons for alignment. And clearly, the vendors are subject to restrictions as you expect under an SPA in relation to locking them in over time. I think more important for us, obviously, we've got some great vendors who we're enjoying working with, but also making sure then we start to work with the next layer of leadership in each of those organizations, putting incentives in place for them so that when actually ultimately earn-out periods are over, we have succession planning. So should the entrepreneurs think about, I suppose, enjoying the fruits of their labor. From the point of view of how we go through that integration process, you'll look at businesses like BusinessWise and Ignite, where they're really all about maximizing the revenue synergy. So from that point of view, we won't do that much restructuring in the first couple of years or during that earn-out period. We'll get everyone on the same IT security. We'll get them on the same HR processes, but then we'll really make sure those businesses are focused on growing revenues. Gem would be an example of a smaller business where basically we've got a talented entrepreneur who's staying with the business and working in other areas, and we've been able to integrate the general operations fully into the Inspired business. And also you'd see the same process with LSI. I think what we try and make sure is that we do operational processes first and save any client-facing processes till the end to make sure all the time the service to the client is preserved and improved during that integration process.
That's great, thank you. Which division offers the greatest potential? ESG Energy or Software Solutions?
So I think in terms of absolute revenue line, it's your ESG division by a long way. Ultimately, that technology-enabled service provision into a market in the UK that's kind of 1.1 billion in size by our estimates. That's the biggest opportunity in terms of revenue growth. I think what the software business does for us is it just gives us obviously a great EBITDA margin. It gives us the ability to access units of opportunity and work with people who own those units of opportunity that we wouldn't normally get. And it gives us that, if you like, double bang for our buck in relation to CapEx that we would have to spend anyway to be able to provide our technology-enabled service. But ESG will be, to my mind, a bigger proportion of the revenue should we execute effectively.
Great, thanks, Mark. Question in relation to Gazprom. Can you give us more detail on the Gazprom effect on the business? One for you, Dave.
Yeah, sure. So Gazprom is a major supplier to businesses in the UK. They supply about 24-25%, something like that, of the market. Noting that actually that is all traded in the UK. That's not Russian gas that's specifically imported for that. As has been widely publicised, obviously customers are choosing not to renew contracts with Gazprom, and therefore it's putting financial pressure on that business. Now, the current situation is that Gazprom are continuing to trade, and they are continuing to pay their bills and their debts and so on. So at this moment in time, there is no reason for, or no legal reason for customers to get out of contracts with Gazprom. And in fact, it would be very expensive for them to do so, because they'll be faced with current energy rates versus the energy rates that they've hedged at already. So the advice we're giving clients is to very clearly signal their intent. So at the earliest possible opportunity, which is usually on renewal, to start to look now at being able to place their renewal contract, whenever that's due for renewal, with another supplier. And that clearly they're moving away from Gazprom at their earliest opportunity. So the question then is, what happens to Gazprom in the meantime? Lots of press speculation about what's going to happen. I think it's widely accepted Gazprom is too big to go into a normal industry supplier of last resort situation, where an Ofgem appointed supplier takes over. They're just too big to do that. Nobody would be able to cope with that. So the most likely outcome is similar to that in which Bulb as a supplier finds itself, which is with a special administrator appointed. Now, it depends on the mandate of that special administrator as to whether they're mandated to run that business as a going concern and sell it on, which is a possibility, or whether they're mandated to go in and to minimise losses and to sell that business on, and whether or not there is any governmental intervention, because I think the support cost of doing so anywhere between £5 and £7 billion if customers were to have their contracts with Gazprom honoured at the cost of the UK taxpayer. That's the kind of bill that would be expected. Now, clearly, that's a shock for many customers. If the UK government didn't step in and Gazprom were to go into administration, they were faced with having to replace existing contracts at current market rates. So, if that were to happen, in some ways, that becomes an opportunity for Inspired, because we would place all of our customer contracts with alternative suppliers. And of course, there are, Gazprom being a big supplier, there would be other potential customers that would require our services. So in that instance, there would be an opportunity for us. The only word of doubt, therefore, is around that kind of mandate and the sheer size and scale of Gazprom, as to this is uncharted territory. We don't know how the government would react, and if any assistance would be put in there that might kind of change the landscape in any way, shape or form. So given its scale, that's why we did the release a few days ago, just to highlight that, given all the press speculation. But equally, that's by no means an actual done deal. There are lots of variables and lots of opportunity for that to be advantageous to Inspired as well.
Thanks, Dave. So the final question we've got is, how much revenue is linked to share of energy savings, and has the current environment been a catalyst for new business? So I'll take the first part, and then Mark can take the second part in terms of new business generation. So the PCMG part of the business Mark referred to before generated £2 million of revenue this year, which is pretty consistent to how it performed in the previous year. And then guess, Mark, in terms of new business catalyst.
Yeah, so I mean, I guess you've got two things going on there. Whenever there's price volatility and times of high prices, it clearly puts energy up the board agenda, and certainly we've seen a number of organisations really looking to work with the player of scale in the market, which is ourselves, because actually they need more support during these challenging times than perhaps they've previously been getting. So there's a driver there. And I think that was referenced in terms of the great work Dave and the team have been doing in relation to new business generation in the first couple of months of the year. I think the other driver here is that just with energy prices where they are, the economics of energy efficiency, carbon reduction projects has just never been better. And from that point of view, you've got a lot of stimulus there in relation to demand. So I think the macroeconomic backdrop is obviously challenging in relation to the current situation with the energy crisis and the war in Ukraine. As those things, if you like, reach reach a kind of hopefully resolved, then you're in a situation where businesses will be focused on making sure they can deliver those energy reductions and ensure that they don't find themselves exposed to an energy crisis in the future. And typically that's normally a good impetus for us in terms of new business generation.
Great stuff.
Thank you. Thank you for that. I think that might be a time for me to pick up, because I think you've actually addressed those questions you can from investors, and of course the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Mark, I was just wondering if I could ask you for a few closing comments.
Yeah, look, I mean, first of all, we'd like to make sure we thank the team who've worked tirelessly to help clients through what have been a difficult couple of years. And they've done an amazing job, and to thank the investors that we have for being so supportive of our strategy during that period of time. I think we're particularly excited by the ESG opportunity, and that's really evidenced by the EBITDA investment we're prepared to make into it, and equally the potential for actually making a difference to clients in relation to carbon emissions via optimization services. Having strengthened the bandwidth of the executive board and having improved the kind of bandwidth from a non-executive point of view, and having achieved a 37.5% gender diversity, all of the right kind of steps are in place as we really go on the journey to professionalize ourselves as a business and take advantage of what is a really exciting growth environment over the coming years.
Thank you very much for that, Mark, Paul, and David. Thank you again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback, and all of the management team can better understand your views and expectations. This will only take a few minutes to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Inspired PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.